In this example, we are looking at treasury stock transaction using T accounts. So on the bottom of the screen, you can see the transactions we're going to place into the T accounts at the top of the screen. They are going to include cash, treasury stock, as well as our paid-in capital for our treasury stock. So on May 5th, it says that we purchased 1,600 shares of our own $2 par value common stock for $40 per share. So the first thing that occurs here on May 5th is we purchased 1,600 shares, so we're going to credit cash, and then we are going to debit our treasury stock account for the amount that we purchased, and then we're also going to have to account for the difference in our paid-in capital account. So the first thing I'm going to do is I'm going to credit our cash account. So this is May 5th. And on May 5th, we purchased 1,600 shares, and we purchased them in the amount of $40 a share. So 1,600 shares times $40 is $64,000. So that's the amount of cash that we're spending to buy our treasury stock. And then also our treasury stock, the $40 is our cost. So everything that affects treasury stock from this point on is going to be in the amount of $40. So I spent $6,400, and then on May 5th I also have $100,000 worth of treasury stock. Okay, so $40 is our cost, and we purchased 1,600 shares. Now this $2 par value doesn't matter at this point in time. Later on, when we do the retirement of treasury stock, then we have to take the par value into consideration. Because remember, the par value is only used when we access our legal capital account, which is our common stock account. So then on the 17th, I sold 600 shares of treasury stock purchased on May 5th for $44 per share. So first, let's look at this. I bought them for $40, and I'm selling them for $44. So I'm making $4 per share on this transaction. So the first thing I'm going to do is I'm going to reduce my treasury stock account on May 17th. And I sold 600 shares, but remember, I know I sold them for $4,400, but when it comes to treasury stock, everything in this account is recorded at cost. So it's going to be 600 times my $40, so that's $24,000. So I'm crediting treasury stock for $24,000. Well, let's look how much cash I collected. So on May 17th, I sold the 600 shares we're talking about, but it's the cash that's going to get the $44 per share. So I sold and collected 600 shares times $44 per share, which is $26,400. So we have a difference here. Remember, for every transaction, our debits must equal our credits, and I have a difference here between these two. So I'm going to have another credit, and this is what we use our paid-in capital treasury stock for. It's similar to the additional paid-in capital account you use. So any amount over the $40 per share is going to be recorded into the paid-in capital account. So on May 17th, it was $4 over, so 4 times 600 is my $2,400. And so now my $24,000 plus my $2,400 credit on the 17th equal my $26,400 debit on the 17th. Then on the 21st, I sold 400 more shares. 400 shares of our treasury stock purchased on May 5th for $40 per share. So now I'm selling them for exactly what I bought them for. So we're not going to have any addition or any paid-in capital for our treasury stock. So if I sold 400 shares on May 21st, my 400, this is always times our $40 per share, is $16,000. And then that's exactly how much cash I received too, because I sold them for $40 and I bought them for $40. So on the 21st, I have $16,000. So I broke even on the 21st. I didn't make any money and I didn't lose any money. But now if you look on the 28th, I sold my remaining 600 shares, and this time I sold them for $38. So I sold them for $2 less. So let's see what happens in this scenario. I sold the remaining 600 shares, so we're going to debit our cash account for the amount of cash that we received, which is the 600 shares times the $38, so that's $22,800. Okay, then we're going to look at our treasury stock for common. On the 28th, I sold my 600 shares, and yes, I sold them for 38, but the treasury stock, every transaction is based on our cost, which was $40. So this credit to treasury stock is going to be for 600 times my 40 for 24,000. Because you're never going to have a negative balance in your treasury stock account, because every transaction is based on your cost of $40, regardless of what you sold it for. So I have a discrepancy here, right? 22,800 and then 24,000 here. So what's going to happen then is on May 28th, since I have a loss, or I sold them at a loss, I'm going to debit my paid-in capital account for the difference. So my difference is $2 per share, the difference between the 40 I bought them for and the 38 I'm selling them for, times the 600, so it's going to be 1,200. And I just want to point out to you right here, this is going to leave us a balance in here of 1,200. Later on down the road, though, we have to keep in mind that I can't ever take more out of this paid-in capital account than what is in here. So if this was going to be 3,600 debit, I would only be able to take the 2,400 out, and then that's when we'd bring in our account called retained earnings, and E9B is going to show you how that works.